So I have a quick question for you. Would you invest into real estate without putting a tenant in your property? Simply just to hold a house? Most likely not, right? So why are you doing the exact same thing with your cryptocurrency assets? Let's dive in. So with inflation being a pretty big problem, not just in the United States, but worldwide, a lot of people have flocked to investments in order to outpace inflation. You have your real estate investments where people invest into properties. Ultimately, they are putting tenants in their properties. And the reason why is because properties have upkeep. And it makes no sense to just build equity on your own when you could be building equity using a tenant and they could be the one that's producing your income. It's a way better return on investment, in my personal opinion. Now, with that being said, people also invest into cryptocurrency in hopes to outpace inflation, but also see more substantial returns and see better returns in general. A lot of people investing into cryptocurrency are actually not investing in it knowing that they could be earning cash flow on their assets. They're investing and they're hodling their assets, waiting for those assets to rise in price and ultimately speculating on future gains. Now, keep in mind, I'm a big crypto guy. I have a lot of my portfolio, my overall investment portfolio in crypto, but at the same time, I can understand that holding crypto is not the best strategy, or at least you shouldn't be overexposed to it. The reason why is because these assets are volatile. Not to mention, these assets have market cycles, meaning that every 4 years or so is when we're going to see a bull run. Every 4 years or so is when we're going to see a bear market, so on and so forth, basically. And I also understand that we're speculating on future price movements, and crypto is not nearly as old as real estate or other traditional investments, right? So a lot of people deem crypto as a riskier investment. And what a lot of people don't factor in or don't often look at when we're talking about risk is the return associated with it. And what I'm referring to is the risk adjusted return, basically. And the reason why is because if you can take an absurd amount of risk, but ultimately your return is going to make up for it and it's going to make up for that risk faster, well, it's a no-brainer. And your overall risk actually goes down because you can make that money back faster. Let me give you an example. If you were to park, say, $10,000 into a startup, let's just say, and that startup is expected to pay you, let's just say, $15,000 in dividends within 3 months. Obviously, a crazy example, basically. You keep your equity, you turn 10K into 15K basically into 3 months, boom. Remember, this is a sunk cost. This is not naturally as risky as investing into a startup 10K basically, where it doesn't have a product, doesn't have product market fit. It's just simply a startup, right? And you're expected to make maybe 15K back over the course of, let's just say, 3 years. While both have an equal amount of risk, you're investing into a startup, this one right here has a better risk adjusted return. The reason why is because the return comes quicker. The risk is the same, right? But ultimately, the $15,000 comes quicker right over here in 3 months, therefore meaning that your risk adjusted return is a lot healthier. Now, when we're investing into crypto, we're already taking absurd amounts of risk. Whether we want to admit it or not, crypto industry is risky and volatile, right? We can see assets, even including the biggest like Bitcoin, going down 10% in a day. We can see them going up 15% in a day. That's why we're in crypto. But wouldn't you rather have a better risk adjusted return, a more healthy risk adjusted return? So that way you can sleep at night without checking the crypto charts, but on top of that, produce more income. And this is a very, very important factor. A lot of people take their crypto and they just hold it, right? And I am here to tell you that this is not the strategy. The reason why is because crypto actually has inflation built into it for most cryptocurrencies. On top of that, we are speculating on future gains, and just simply holding crypto is the equivalent of having a real estate property with no tenant in it, basically. It's just simply not a good idea. Why have a property with nobody in it when you could have a property with somebody in it producing you income and actually paying your mortgage and your utilities and bills every single month? It's just a better concept in general. So with that being said, I have the question to ask you. Why hold crypto when you can produce income and have full market exposure to that crypto as well, right? So taking what you're already doing, which is holding cryptocurrency assets and producing APRs anywhere from 50 to 150% APR. That's an absolute no-brainer in my opinion. You have exposure when Bitcoin goes up. You actually have exposure when it goes down as well, and whatever other cryptocurrency assets you're holding. But ultimately, in the meantime, while you are waiting for those prices to go up, right, you are generating income of 50 to 150% APR, and that's on a yearly basis, keep in mind, which could come out to, and is coming out to in my personal portfolio, 10% per month, basically. It's a very good return. You can use this as a profit-taking strategy, so you can put that money in your bank account, so that way you can hold your crypto year-round, basically, without having to sell in one market, buy in another market, right? Just take the profits from the actual yield that you get. You can use this as a compounding technique to ultimately build your portfolio. You could use this as a vehicle to invest in other investment streams. Like maybe you do want to get into real estate or other markets, right? You just haven't had the capital, and also maybe you don't want to sell your crypto. crypto. You can do these 3 things with what I'm about to tell you. And very quickly, what I want to go over is the inflation packed right into cryptocurrency. Bitcoin currently has a circulating supply of 19.8 million tokens. It has a max supply of 21 million tokens. With that being said, it's still inflating. Bitcoin's not that bad, so we're not going to single it out. What I am going to single out is assets like Solana, right? It has an infinite supply, and it currently has 486 million tokens in circulation. Now, what I also want to go ahead and tap into is if we zoom out, we look at the max chart for Solana, you'll notice right over here, it hit a peak price of $260. We have since surpassed that peak price. We went all the way up to a peak price of $293, right? But let me show you the difference. If we look at the $260 price point and the market cap of it at that same time, it was roughly a $75 billion market cap. If we look over here when Solana hit $260, once again, let's just say 256, right over there, right? Its market cap was substantially higher at $122 billion. So you went from a market cap of roughly $75 billion all the way up to $122 billion, yet you are at the exact same price. Why? Because they printed more tokens. That's just the simple model behind Solana. Now, I'm not going at Solana or anything like that, nor am I going at the US dollar. Like the US dollar, people invest their dollars so they can outpace inflation. You should be investing your Solana tokens so you can outpace this Solana inflation. And some do that through staking, but you really only get 8% per year staking. You're kind of just breaking even, if not underpacing it, right? Ultimately, what you do want to do is park it into yield generating assets that generate you high APRs like 50 to 150%. So that way you can make the risk worth it and you can have a better risk adjusted return. Now, again, I'm not going to single out Solana either because all cryptocurrencies do this. Ethereum, 120 million in circulation, has a max supply of infinity. Now, that being said, Ethereum does have a burning mechanism in place, which basically means, yes, they are constantly putting new tokens in, but they're taking old tokens out based on whenever there's transaction fees. So you can see ever since they enabled this over here, Ethereum stagnated at roughly 120 million tokens in circulation. It's gone up a little bit, gone down a little bit, but ultimately it's around the same range. And if anything, a couple tokens have been taken out of circulation, which is great. It just shows us that, yes, Ethereum is going to continue to inflate at an infinite pace, but as long as there's transaction volume on Ethereum, not to mention some of these times were pretty bearish, like 2022, 2023, right? It's still going to take tokens out of circulation, and that burning rate is still going to outpace any inflation in it. So again, Ethereum does the same exact thing. That system can break, but it does have a system in place for outpacing inflation. But again, you can still capitalize on opportunities with Ethereum earning 50 to 150% APR. Other assets like Chainlink, they currently have a circulating supply of 638 million tokens, but they have a max supply of 1 billion tokens. These tokens will be put in circulation over time. I want to go ahead and put this in perspective. Right now, Chainlink is $24. If nobody were to buy Chainlink and nobody were to sell Chainlink over the course that these next 300 or so million tokens are minted and put into circulation, Chainlink would be at an average price of roughly $15. And I highly encourage you to do this for some of the tokens that you're currently holding, but you take the market cap as reported by CoinGecko, which is $15 billion, and you divide it by the max supply, which is 1 billion tokens. And that will give us 15.54. That will tell us the price of Ethereum, assuming there's no more buys or sells, or maybe there's an equal amount of buys and sells, but ultimately just more tokens come into circulation. That knocks the price down over time, which is significantly down from the price of $25 nearly. And the thing is, as I mentioned, most tokens, they're like this. Uniswap currently has a 600 million circulating supply and 1 billion in total tokens, so about 60% in circulation. If we dive into, let's just say, Ondo over here, it has 3.1, nearly 3.2 billion in circulation with a $10 billion total max supply. Some tokens are better off than others, obviously, with more in circulation, but we kind of have to accept this fact when investing into cryptocurrency. We can't just go and avoid all the cryptocurrencies that don't have their full supply in circulation and are done with inflation, because that's less than 10% of all cryptocurrencies at the end of the day. We have to find high utility cryptocurrencies that, number one, have enough demand to outpace their inflation, but number two, also have income generating strategies attached to them where we can earn APRs of 50 to 150%. So that way we can ultimately outpace inflation and have better risk adjusted returns. So again, if you guys want me to reveal in my next video what this mechanism is, how you can earn these APRs of 50 to 150% per year, feel free to let me know. know, and I do want to go ahead and just show you that I'm not speaking out of my ass and kind of pull up my dashboard. I just entered this desync to Ethereum liquidity pool yesterday. Now, you might not know what desync is, but I can promise you it is not a meme coin. It's a revenue generating asset that injects that revenue back into the ecosystem. Anyways, I've earned $27 just in the past 21 hours or so off of roughly $13,600. Now, this is a lower return of roughly 83%. So again, that's on the lower scale. I also have positions over here on the Solana network, which are doing a 134% APR on average, producing me roughly $53 per day off of $14,000. Then I have a wide variety of positions across about $30,000 to $40,000 of capital over on other networks and exchanges. But with that being said, I want to show you just how this system works, like from a high level overview. And then if you want me to, in my next video, I'll dive deeper into it and how you can kind of implement it into your portfolio. We have stuff like Sol USDC. This is at an overall profit for me, like $165 or so. And of that $165, $145 is income, right? So even though Solana has not really changed in price since I entered, I've only made about $20 from Solana going up. I've produced about $145 in income, which means that instead of being up $20, I'm up $165, significantly more, because I'm generating a 156% APR. Pyth Sol, I'm actually down $1,000, but instead of being down $1,200 or so, I'm only down $1,000 because I have about $200 in income from this position. So again, it's all about market positioning. There's times where you invest into a HODL or you do a dollar cost average. Within a couple days, the market dips more, you're down, right? Maybe the price is a little bit lower, but you're holding out because you're focused on the long term. You're going to sell towards the market top, at least you hope so, right? So you're just like, okay, I'm going to let this ride because investments go up, they go down. The important part is that you're not selling when they're down, right? And that you actually have high growth assets that are going to go up in the future. Well, that's exactly what I'm doing with Pyth. So even though I'm down over the long term, I produce more income, my assets do go back into the profit, and I have more money than if I was just holding Pyth or holding Sol or holding both the assets, right? That's what this strategy allows me to do, and I'm generating a 105% APR right here. So again, this is not a new concept. People do this with real estate when they go and they buy houses. Instead of just letting the real estate sit there and nobody be in that property and having to take money out of their pocket and park it into that property for upkeep, property taxes, insurance, stuff like that, they go and they find somebody that doesn't have a lot of capital up front to, invest into their own first home or something like that, or maybe somebody that just wants to move around a lot that has maybe 12-month leases or something like that. They find that person and they then go and they put them in that property, and that person right there maybe pays them $4,000 a month. Obviously, they're paying a little bit more of a premium because they don't have to put as much capital up front, or they have the flexibility of moving around, not having to pay real estate commissions when they go to sell the property. But ultimately, over here, this person is paying a mortgage and utilities and property tax and insurance and everything like that, maybe 3.5K, and they're cash flowing about, say, $500 a month or so. Not that much, right? Not that high of an APR, but ultimately they are building equity in this property. So maybe that's a $500,000 property, $500,000 that they might owe, say, $300K on. Well, that $300K is being paid off by this person right here through that person's rent, essentially, and they're building equity in the property. So again, you can do this exact same concept in DeFi. It's a little bit different, obviously, because the beauty of crypto is it's liquid, arguably better in my personal opinion, but again, I'm a biased person that's been in this industry for 4 years. But you have your cryptocurrency assets, and your cryptocurrency assets get put into yield generation strategies, and ultimately those yield generation strategies produce you 50 to 150% APR. And once again, just a little bit sneak peek. Again, if you guys want me to do a full video, let me know by dropping a like and subscribe when notifications turned on. That 50 to 150% APR is not a Ponzi scheme, it's not a pyramid scheme, nothing like that. People want to trade assets. So if you have Bitcoin, let's just say, and Ethereum, and somebody over here wants to trade, let's just say, some BTC for Ethereum, well, ultimately they give you some BTC, you'll give them some Ethereum, just like that. And obviously we get a fee whenever they give us BTC, so we're gonna get a little bit more than we're gonna actually give them. And that's what that 50 to 150% APR is, right? It's not any Ponzi scheme or anything like that. So I just want to put that out there. Again, that wraps up today's video. If you enjoyed, drop a like, subscribe, notifications turned on. I hope you guys did enjoy. Hope you guys found some value out of this, and I'll see you guys in the next one. Peace out.